Good afternoon and welcome to the Public Service Commission of South Carolina. We are here for an allowable ex parte briefing this afternoon by Sabre Partners, LLC. We appreciate everyone's patience. We've experienced a little bit of technical difficulty, but we think we've got everything straight now. Before we begin, let's take a roll call of commissioners. Present in the hearing room, we have Commissioner J. Williams, Vice Chair Powers, Commissioner Thomas, Commissioner C. Williams, Commissioner Caston, Chair Belser, and with us virtually we have Commissioner Irvin. Before we get into instructions, let's just take appearances right now. And representing Sabre Partners,
Joseph Fichera.
Need you to turn your microphone on, please, Mr. Fichera. Thank you, sir.
Joseph Fichera.
Thank you, sir. And as our neutral from the Office of Regulatory Staff.
Thank you, Madam Chair and members of the Commission. Yes, my name is Chris Huber, and I'm here as the attorney for the Office of Regulatory Staff, and I am the Executive Director of ORS's designee for purposes of today's briefing.
Thank you, Mr. Huber. We have a little bit of housekeeping that we need to take care of before we begin, and I'm going to recognize our staff counsel this afternoon, Ms. Sandra Mosier.
Thank you, Madam Chair. Good afternoon, Commissioners, and to all who are present here today, either in person or virtually. Today is Monday, January the 30th, 2023, and we are here in the Commission's hearing room pursuant to a notice of request for an allowable ex parte briefing from Sabre Partners, LLC. The subject matter notice to be discussed today relates to, first, the bond issuance process, market considerations for bond issues, investor considerations for bond investments, the role of the regulator in the bond issuance process, consumer benefits for bond impacts, and other factors to be considered for bond issues. Thank you. I can do that. Commissioners and all present here today, I would remind everyone this is a briefing and not a hearing. The briefing must be conducted in compliance with the provisions of South Carolina Code Section 58-3-260C, and the requirements of that statute are, in part, that the allowable ex parte briefing be confined to the subject matter which has been noticed. I would therefore ask the presenters, commissioners, and staff to please refrain from discussing any matters not related to the specific topics. The statute prohibits any presenter, commissioners, or commission staff from requesting or giving any commitment, predetermination, or prediction regarding any action by any commissioner as to an ultimate issue which either is or is likely to come before the commission. I would also ask the presenters, staff, and commissioners to refrain from referencing any report, article, statute, or document of any kind that are not included in today's presentation. A copy of any document which is referenced during the briefing must be provided to the Office of Regulatory Staff for inclusion into the record, which will be certified to the Chief Clerk of the Commission, Ms. Jocelyn Boyd. If anyone during the course of this briefing exceeds the scope or does not comply with or fails to conduct themselves within the provisions of South Carolina Code Section 58-3-260 governing allowable ex parte briefings, it is expected that a contemporaneous objection will be made. And finally, everyone in attendance today, in person or virtually, must sign in or register. Everyone in the hearing room or watching virtually must read, sign, and return the form which you were given at the door or the form which will be emailed to you for your virtual appearance, which will include instructions and the delivery and deadline for its return. It is required by law for each attendee, whether attending virtually or in person, to certify that the requirements contained in Section 58-3-260C have been complied with in this presentation. Thank you all for your time and your attention to this matter. Thank you, Madam Chair.
Thank you, Ms. Mosier. Mr. Huber, as the designated neutral and designee for the Executive Director of ORS, do you have any additional instructions or comments?
Thank you, Madam Chair. The only thing I would add is, because of some unique statutes that apply in securitization proceedings, to the extent any materials need to be sent to ORS following today's briefing, anything's referenced, I would ask that all parties to docket number 222, 256E be copied when they're sent to ORS.
Thank you for that, Mr. Huber. Well, that's a good idea, and thank you for that.
Thank you, Madam Chair.
Mr. Fichera, thank you for being here with us today to talk to us about this securitization or storm damage recovery law in South Carolina. And with that, I'm going to turn the presentation over to you. And I think you've got some folks virtually that are going to assist you. Is that right?
Yes,
Okay.
I do.
Thank you, sir.
Where is the camera? Over there. Okay. Thank you very much. Sorry for the delays. We are, and now this isn't working.
Is the clicker working?
Yeah, there we go. I think the battery's loaded. All right.
You may need to adjust that microphone up a little bit. So there you go. Thank you.
So basically, in our work plan, we've told you that our jobs are to inform, educate, evaluate, propose, and implement. The resources that we have for you, a number of people are on the phone besides myself. First, the entire Sabre team resource. We have Brian Marr, who is the former Exxon Assistant Treasurer, handled a lot of their external finance. Hyman Schoenblum, who is the former Treasurer of Consolidated Edison of New York. Paul Sutherland, the former Assistant Treasurer of Florida Power and Light. Barry Abramson, who is a former utility research analyst. Steve Heller, who is a president of Analytic Aid, who the former financial modeler, modeled multiple of these transactions while at Credit Suisse and at Merrill Lynch. Rebecca Klein, who's the former chair of the Texas Public Utility Commission. Paul Forrester, who is also a counsel with Mayor Brown, and Peter Baumgarten, counsel with Holland and Light. Paul was the counsel to the North Carolina Utilities Commission and their storm securitization. It was not Sabre's counsel at that time. Peter was is counsel to the Missouri Public Service Commission, and worked in these ways. And I wanted to, these people are on the phone, and I wanted to introduce them and see, Brian, are you there? Brian Marr, do we have him? I think we may have lost. Brian, I see you.
I'm here.
Okay. What I'm going to just ask you, just each of you to just speak for just 1 or 2 minutes about the things that you've testified and worked on before. Brian and I have known each other since 1988 when he was at Exxon Corporation. Brian,
Sure.
just give a little in terms of your areas of expertise and how you're going to be approaching, providing resources for the commission in the bond market issues.
Great. Good afternoon, commissioners, and everybody else. I was a financial executive with a lot of different responsibilities at Exxon, but one of those was head of capital markets with the responsibility for all of our capital market financing. And I learned, and that during that job, that you have to work hard, even if you're Exxon, to get the best rate when you're trying to do a financing. And the reason is that nobody has ill will towards you, but underwriters who are going to produce your offering are basically, and they say so in their contract, out for themselves. You know, they have an obligation to work with you and do good work with you, but basically they don't have a fiduciary responsibility to do the best work that they can for you. And I think probably you all know that because of, you know, for example, if you, in your own personal finances, if we talk to our financial advisor and you really trust him and you want to buy a bond, he's going to go negotiate with his trading desk and try to get the best rate he can for you. Meanwhile, the trading desk are in between us and the issuers are trying to get, the underwriters are trying to get a good rate for their clients. And at the end of the day, the firm as a whole is trying to do something in between, so they please their investors and they please their financing customers. So, but if you are the issuer and you're trying to get the best rate, in my case for Exxon, or in this case now for the ratepayer, you have to be very careful, because what they call the best judgment of the underwriter isn't necessarily the best rate you're going to get. So it was not uncommon in our case, for example, that we would go out to do a financing and someone would say, okay, the market here is clear. It's 40 basis points above treasurers for Exxon. And you talk to a few others, they'll say something like that. And then you go back and say, okay, now we're going to have a bid. In 15 minutes, everybody give us their best bid. And somehow the 40 would turn into a 20. And that's the kind of thing that happens if you negotiate hard and if you make underwriters bid. And so I basically learned that you don't take yes for an answer when they come up with their best judgment. So my expertise here would be involvement as much as possible in the actual financing process. We've got a lot of resources here, and we can pretty much tell where your financing should come out. And your AAA, Exxon was AAA, and Joe's going to say a lot more about this, but basically, my part of the job here is to help you in the negotiating process to get the best rate you can.
Thanks, Brian. Hyman, are you there? Hyman Schoenblum, former treasurer of Consolidated Edison. They've been waiting. I see you there, Hyman. You're on mute. Hyman? Can't hear you. All right, we might have to go to Hyman. Can't hear you. Let's go to Paul Sutherland. We'll come back to Paul. Was here last. Came the last presentation. He didn't get to say much at all, and I promised that he would talk a lot today. So Paul Sutherland, who does former assistant treasurer at Florida Power and Light. Paul, why don't you talk a little bit about your specific area of focus within Sabre and our assignments?
Sure. I spent about 20 years at Florida Power and Light doing many different types of financings: equity, tax-exempt bonds, taxable bonds, preferred stock. And then I moved to Sabre Partners and spent another 20 years focusing mainly on rate reduction bonds, ratepayer-backed bonds, otherwise known as utility securitizations. And my particular area of expertise, where I contribute the most to the process, is analytical. I have an undergraduate degree in engineering, so I feel comfortable with numbers. And what I've found is that, as you've heard before, I'm sure numbers don't lie, but liars can use numbers very effectively sometimes.
Statistics.
So we don't accept numbers at face value. We analyze them and look at them from many different points of view. As we go through the presentation today, a good many of the charts are charts that I have generated through an analytical process, which I will explain and we'll go into a little bit more detail in hopes that we can convey the different points of view that can be expressed through numbers and how you can arrive at different answers depending on how you look at the same numbers.
Okay. We also have with us Rebecca Klein, who is the former chair of the Public Utility Commission of Texas. She serves on our advisory board, which is a not compensated position, but does get, in these assignments, is compensated for her time. But Becky, are you there?
Here, it's a pleasure
Yes.
to be with you, commissioners and staff. As Joe had mentioned previously, I had been chair of the PUC, and that was a little over 20 years ago. So we have known each other for, gosh, almost 23 years. And that's when I started working with Joe, is when I was chairing the PUC, working with Sabre Partners. And the significance of that, albeit years ago, is that during my tenure, we oversaw the first 3 securitization transactions in Texas, which amounted to approximately $3 billion. And that was with 3 different utilities. And we had decided to hire Sabre Partners at that time to augment our internal financial staff and their capabilities. And what ended up happening is that Sabre Partner was able to develop for us at the commission a program of securitization, such that after several securitization transactions that Sabre Partner took us through, we were able to internalize certain aspects of the expertise, not all, to be able to over time incorporate some of these capabilities in-house and be able to undertake some securitization transactions at the commission post my tenure independently. And so that was a big gift that Sabre Partner did after working with us on several transactions. And so one of the things that I work on with Sabre in my advisory capacity is just really being able to, as Joe said, Sabre educates and informs. And so in that capacity, my role is to really share the importance and benefits of incorporating a lowest securitization charge standard and what that means and why it's important. The other thing is also helping inform on actions taken at the Utility Commission in Texas that we took in tandem with an independent financial advisor that resulted in that benchmark of the lowest securitization charges. And then also explaining why having an entity with the statutory duty to the ratepayer, i.e. the commission, is instrumental in reaching that lowest cost standard. So that's the role and kind of the reason that I am here today, and look forward to any questions that you might have in that regard. Unfortunately, I only have 20 more minutes with you, but I look forward to that discussion. Thank you.
Okay, in terms of our plan, we are here. We're starting to evaluate the procedures and programs for efficiency and effectiveness within for South Carolina. We've identified, this is like the first beginning of a discussion about the bond market, about the offering process. And as we go forward, we'll be following these kinds of procedures to, yes, just give a little click delay here, in order to be able to complete the transaction quickly and effectively at the lowest cost. One of the issues that is coming up will be like a maturity example of what these storm recovery bonds have been and what the marketplace and investors would like. Our first storm recovery bond transaction was Florida Power and Light in 2007. They did about a 12-year longest maturity. Then you've seen 14, 10, 12, and then Duke in North Carolina did 20, and Oklahoma recently did 28, and all showing that there is demand, but there are intergenerational issues and concerns to be talking about in terms of the period of time in which you want storm recovery charges to be on the bill. Now, we've sent you a some of our publications in order to give you some more detail and background on it. First one was there's a lot of jargon and other sorts. We thought you need a glossary of terms. We'll try not to use as much jargon, try to speak plain English as possible, but please do not let, this is how investment bankers, they say various things that you should stop them and say, I don't understand that. Could you say that in English, please? And many people don't because they say, well, I don't want to look like I don't know what, please. Anytime we use jargon stuff, we've got to be in English. We're going to get to the discount rate, and we're going to get into benchmarking and other methodologies later on, but this is a general overview. And in that jargon, I thought we'd just go over a couple of key things you're going to hear. The word tranche. Now that means a specific slice of a bond issue that has a specific maturity associated with it. So a bond issue of $500 million may have 5 $100 million tranches. You might think of them as series, but jargon is used to call tranche. Then you're going to hear things about scheduled maturity versus final maturity. I think we all know, we think what a maturity is, which is payment and due. But in this type of transaction, there's going to be a maturity that's scheduled to be paid and then a maturity that has to be paid. Why the two different dates? Only because of the fluctuation of some of the cash that would be coming in to pay the bonds might not arrive on time, and you have a cushion area there between the scheduled and the final maturities. If you miss the scheduled maturity, it's not an event of default. If you miss the final maturity, it is an event of default. So the distinction between those two maturities is when do creditor rights kick in. Then you see your sinking fund or amortization schedule. This is like your home mortgage. This is how, when we're going to pay the principal back in addition to the interest over time. Now, the weighted average life is how long that bond really is outstanding, even though the maturity might be longer. For example, if you have a 30-year mortgage and it's paying principal and interest level over time, the weighted average life of that mortgage is not 30 years. It's much less, more like 15 years in terms of over time. So a tranche may have a maturity of 18 years, but it may have a weighted average life of 12 or something, depending upon how the sinking fund and schedule comes about. Obviously, coupon and interest rate, pretty standard in terms of that, but the key additional thing is that those coupons are set versus a benchmark, and the benchmark is usually U.S. Treasuries, and then the spread over that benchmark is what you pay in terms of the ultimate interest rate. And everything comes down in terms of the credit spread to what we call relative value. And how is that spread and that interest rate compared to some other spread, another interest rate for a similar credit? So let's look at the bond market in general, try to give you a background in terms of the structure, size, and of the bond market. And the capitalization okay, there we go. I think that may have been the slide. We sort of start out with taxation in notion of between tax-exempt and taxable bonds, certainly divide the marketplace. And that's really a U.S. kind of feature because tax-exempt from the federal level really doesn't take place elsewhere in the world, and it's really a U.S. phenomenon. Types of securities are treasuries, mortgage-backed securities, corporates, agencies, asset-backed securities, and money markets make up the primary types of securities that are being offered. And the markets are what we call the primary market and the secondary market. The primary market is what we're going to be talking right now, is what we initially sell. That's why you hear initial public offerings. And it's the prime. that's between the issuer and the investor. And then the secondary market is between and among investors, usually between the middlemen. Domestic and foreign obviously creates types of offerings. There are public offerings, which are called the SEC registered offerings, and then there are private placements where you don't have to give as much information as a public offering, and you have certain restrictions like selling it only to very sophisticated individuals or institutions that have $100 million, $50 million in assets. That's a smaller market, so you usually want to do more public. There are negotiated versus competitive bids. There are underwritings versus best efforts. And that's going to be an issue we'll talk about later on, about whether the underwriters will give you a firm bid or whether they're just going to say, we're going to do our best to try to get you a rate, but we're never going to put our capital at risk. And there's a tension there. The types of investors are also important, institutional versus retail. That means institutions are usually large money managers, individuals, you and I. These bonds probably would be appropriate for the individuals as well as institutions because of their high credit quality, but they usually don't get there. And then the total return versus buy and hold. You're going to hear that phrase. Total return is when an investor is trying to maximize income through both the interest rates on the securities, dividends that are being paid, as well as buying and selling the securities at different times, trading. Buy and hold investor is not trying to maximize income over time, get a total return. That person wants safety and security more. He's buying something and putting it away, you know, as my mother did, bought a lot of U.S. savings bonds in the 1970s and 80s and just sat there. Short, long-term investors here you're going to see different market segments. The transparency is also a big issue in the notion that we're all familiar with stock prices being and volumes being very public on exchanges, but in the bond market, it's not an exchange. It's what is called over-the-counter, which means that you're selling between and among investors. There are some electronic facilitators of that and bidding systems and such, but no centralized exchange like the New York Stock Exchange or and the credits, well, we go from investment grade to junk. And here's the size of the market as it is today. $22 trillion of U.S. Treasury securities outstanding. 12 trillion of mortgage-backed securities and 10 trillion of corporate securities. And then you'll see way down to the far right, and this is going to become an issue we'll talk about, asset-backed securities, only $1.5 trillion. Now, a lot of people want to label these bonds as asset-backed securities, and we take issue with that because of the way the structure is, and we'll talk about that later. But you'll see that just from this slide, the size of the market, the larger, more liquid market is the corporate bond market as opposed to these other structured markets. Okay. So as a percentage of the markets, you see that corporates make up about 19%. Asset-backed securities, very small, only 3%. And U.S. Treasuries, obviously, this is what we're all worried about in terms of our national debt, and the largest of the market. The competition for new investments last year, here's, there was about almost $4 trillion worth of corporates, of treasuries issued, 1.3 billion of corporates, and asset-backed security was only 300 billion. All competing for investment dollars, but take a look at the breakdown of what happened here for investor-owned utility tariff bonds. If you see that these bonds were first introduced, type of a bond was introduced in 1997, and after a flurry of initial activity related to deregulation, it's dropped off dramatically after 2001. Beginning in 2005, you see the spike up in new issues, and that's when environmental and other costs were expanded to be able to be used for hurricane and storm recovery. And then in these last 2 years alone, we had $18 billion in 2022 and approximately $2.3 billion in 2021. So $20 billion in just 2 years, leaving that's the last time that was that high outstanding was 2001. And the themes that we could come across from there was that the large volume is the largest ever in just 18 months. And while inflation concerns drove up U.S. Treasuries, investors still wanted quality, and top quality spreads remained low. But unfortunately, the utility tariff funds were poorly priced compared to these high quality grades at much higher spreads. And that is part of the challenge that will be going forward for us going forward. I think it's the battery. And one of the issues, the poor pricings, we say are mispricings relative to their, and an issue that we're briefing you on a little bit later was related to index investors, where these bonds were originally put in the corporate index and then were put out surprisingly into an asset-backed index in the middle of 2022. And that becomes an issue that we think needs to be addressed. Go.
Madam Chair, this is Commissioner Irvin. Could I ask a question at this point?
Mr. Fitzgerald,
Yes.
are you okay with taking
Certainly.
questions?
You're the client.
Go ahead, Commissioner Irvin.
Thank you. Is this process affected by increasing interest rates? You know, the Federal Reserve has made noises about continuing to increase rates to fight inflation. Does there come a point in time where if interest rates go so high, it's no longer attractive to use securitization, or does it really matter?
It does matter, but it doesn't matter as much depending upon what we're going to compare the savings to. If we're looking at the cost of debt versus the combination of the weighted average cost of capital, debt and equity, pretty much it'd be very hard to have interest rates rise as high as higher than the weighted average cost of capital to wipe out all savings. Because the weighted average cost of capital will go up with interest rates as well. There'll be a lag effect in terms of rate cases and such, but it'll be there. But we need to focus on the credit spread. Go ahead.
Could I just mention the reason that rate
who-
reduction bonds?
This is Paul Sutherland.
Thank you.
Excuse me. The reason securitizations may be beneficial even if interest rates increase is because they are treated effectively as off-balance sheet. So when rate reduction bonds are issued, the utility does not need to issue an equivalent amount of equity to offset the debt because it effectively is not debt on their balance sheet. And consequently, it would be very difficult for securitization to not be beneficial even after interest rates have risen substantially.
Thank you.
But the key is to get the maximum savings for the ratepayer under any market conditions. I think we just lost the presentation. But
Can we get the slide deck back?
And Madam Chair, I'd like to ask Commissioner Klein a question since she's going to be leaving us shortly. Commissioner, how many years it was a securitization in the state of Texas? How long did For example, did the ratepayers see it on their utility bills?
We've had about 7 different securitization transactions over the course of time. And so they've all had different tranches, if you will. But our statutory provisions were, and Joe, you may want to help.
I think it was
me
15
remember
years
what I
for
did there.
15 years for the initial transition bonds, and then
But I
with
think
the
it was a
recent,
minimum.
yeah, the recent legislation went to 30 years.
Yes.
Yeah.
So, so I think back to your question, Commissioner, about inflation, that also has an impact on, regardless of, I mean, your statute would dictate just some kind of span of time, but when it gives you some discretion, no doubt, in looking at that. So when you have higher interest rates, it's going to put some amount of pressure on you to try to, on behalf of the consumers anyway, to try to amortize that over a longer period of time. But there's perils in doing that also. So you have to kind of balance the amount of time.
So the shorter the time, the less peril, ratepayers?
Well, you don't get into generational, aspects of it, where if you're doing it for 30 years, you have a whole different generation that is now going to have the securitization on line item on their bill, that, they wouldn't have had anything to do with. So it's keeping that in mind. It's if you were doing this 2 years ago with, very low interest rates, it wouldn't be a problem doing it with a shorter amount of time, as much as it would be now with higher inflation rates, where you want to spread that peanut butter a little thinner over a longer period of time. And that's where you at a period of, in this process, there would be different modeling so that you would have the opportunity to understand the trade-offs of the tranche length given the prevailing economics.
And one of the strange things about the markets right now is that short-term rates are higher than long-term rates. So actually staying shorter may increase your interest than going longer. But this intergenerational issue is key. We've looked at that. We think the sweet spot is around 20 years maximum. But you should look at in terms of what kind of savings that you can get, whether to go out further or not. A relative basis. But it's the same thing in terms of if you have a 15-year mortgage versus a 30-year mortgage. One will have a lower interest rate, but the other one will have a higher monthly payment. So you've got to decide how you finance that payment. What is the cost of capital for the ratepayer versus the cost of capital for the utility? Because this is a direct borrowing on the ratepayer. So when we ask for the ratepayer to pay an extra $1, nobody else is coming in between that. They've got to get that extra $1 to pay for the bill. The key is to get.
That brings me to my next question. I know you're going to be leaving us, so I want to ask this question. Did the Texas Commission do anything to try to educate the public? Because this is going to be our first securitization case in South Carolina, and I'm sure there's going to be a lot of questions from ratepayers and from others as to what's this on my bill now. Did you all do any kind of advanced explanation of how all that works?
We did, and I can't agree with you more. That is such an important facet of this, to help the consumer know what's coming down the pike. And so our external affairs, our PR office, did a series of press releases, and also the commissioners themselves had various different venues where they had forums to explain it.
I think we also did a conference call with you, I think one time, with the investor call with the chair when Becky was chair of the commission. I had just been coming off of doing investor calls for the governor of California at the height of the energy crisis, which was a lot of fun. Not. But anyway, in terms of the getting the value here is that if we know about ratings, we're going to get the top rating, AAA, and it goes all the way down to. But take a look at what the bond market really is like. From 1999 to present, you can see a dramatic increase in terms of that corporate bond market, but most of them are lower rated quality securities, triple B or below. There's only $891 billion worth of AAA corporates outstanding. And the number of issuers in the category, at the bottom is that AAA is in red. You can't see the number of issuers there wiped out in terms of the scale because it's down to only 2 that have AAA at both agencies. When we look at the amount of bonds as a percentage, you see that, again, from the beginning, you see from the 90s to the present, a deterioration in the number of high-quality securities and an increase in low-quality securities. Now, that all should be good because we've got a scarce resource. So does it show up in the pricing? Stay tuned. AAAs, as again, and the type of underwriters that we're going to deal with through these are 3 different types, and this is where Brian comes, where we need to understand that investment banking firms have different motivations. The large firms, what we would call flow firms, like Citigroup and JP Morgan, are producing a lot of bonds and selling them through their sales force. And so they don't want to spend a lot of time necessarily working on any specific issue as opposed to just producing. Regional firms usually follow along with the bigger firms because they have more supply, but might be willing to focus more if you give them an opportunity. And then there are boutique firms that will focus on it. The types of investors are been primarily large companies. And you can break them down here, sort of as we said before. The index buyers are people who buy things that are because they're matching an index. Institutional and retail, large and small, foreign, domestic, total return, and buy and hold, we think are the primary base. You want to get to the buy and hold because they're usually willing to pay more, accept lower yields for safety and security. The total return people want yield and income. They're willing to take risks. Index buyers generally are passive, though they want yield, but they will often buy things because it's in an index. So that's why the index becomes important. And when we price transactions, it's all about the risks associated with that and we've tried to broke these down to the variety of things, the credit about the ability to pay, the willingness to pay, complexity. You will see in research reports about legislative and regulatory and political risks within a jurisdiction. Headline, will my bonds show up in, or whoever are buying these things show up in the newspaper? That's a risk. Do you want to have to walk into your boss and say, we own those, don't we? That's a risk that people worry about. Liquidity, the ability to sell, and at what price, operational manner, and the famous unknown unknowns of my classmate, sort of from Princeton, who had Don Rumsfeld, who had the famous unknown unknowns of what, in terms of what you have to compensate. There's a lot out there where people don't know about, but you're gonna have to do something about. So let's get to more specifics here again on the bond market and what you're going. We're trying to get you a big picture. If you see in terms of what treasuries and corporates are, types of investors, our guy is, as we talked about, avoid the savings trap, which is simply saying as long as we save money off of the weighted average cost of capital, we can declare a victory and move on, and say we want the maximum amount of savings for the amount of protection that we're giving the investor. And that comes down to measuring success by relative value. And this is where Paul Sutherland does a lot of work in terms of us identifying the value of this bond to other bonds. You know, a two-bedroom condo in one neighborhood compared to a two-bedroom traditional in another neighborhood compared to a two-bedroom. What is the value, and where can we get the greatest value for these bonds? And the way we do this is measuring it through the spread off of the Treasury rate. Paul, do you want to talk a little bit about in terms of just this?
Let me take over for a few slides now. So that slide, Joe, that you just had up there.
Yeah.
First, we need to make sure that we understand what we mean by the word spread. And what we're talking about is spread in basis points. And a basis point is 1/100th of a percent of the interest rate. So 100 basis points would be a 1% increase in the interest rate on the bonds. And so this is just a theoretical relationship chart that shows that the lowest interest rate is going to be on U.S. Treasuries. They have the highest credit rating of any bonds on the market, and certainly will unless the U.S. defaults on its debt. And so the measurement for how well a bond is priced is relative to that low U.S. Treasury rate. And the next best type of debt security above U.S. Treasuries would be AAA rated corporate securities. And so they would be measured as a number of basis points over Treasuries for a certain maturity. And so if we go to the next chart, Joe, this shows the spread for various credit ratings for corporate bonds from AAA to AA, single A, and all the way down to triple B. And it shows what you would expect logically, that the lower the rating, the higher the credit spread is going to be. Okay, go next chart, Joe. And back one, there you go. Okay, so what this chart shows is that there are several different ways that investment bankers, underwriters will price a bond. Several different measurements. They're both related to the U.S. Treasury, but one is the what we call a T-spread, which is the spread between the most recent Treasury bond issue and the spread on the rate reduction bond, which may have a different maturity than the closest Treasury bond. So in this case, for example, the closest Treasury bond to that long tranche was a 20-year Treasury. And the spread of the rate reduction bond was 146 basis points from that 20-year Treasury. So that sounds pretty good. The other way of looking at it is what is the spread called the G spread to the interpolated U.S. Treasury, and that gives you a more accurate perception of how good the pricing was, because that gives you an equal maturity for the Treasury and for the rate reduction bond that you're comparing it to.
All right, let me, Paul, let me just point out. So Treasuries only issued in certain maturities. We have bills, then we go 2, 3, 4, 5, 7, 10, 20, and then 30 years. So there's no 15-year Treasury. There's no 18-year Treasury. There are Treasuries that have 15 years, 17 years, but mostly you go with those main Treasuries as what were the benchmarks, what Paul was talking to. So when you're doing a rate reduction, you're doing a storm recovery bond, maturities may not line up directly on a 20 or a 10 or a 5 or a 3. It might be 17.2 or 21%. So that is where Paul is saying, where is known as the G spread as opposed to the T spread, is to interpolate. So take those different points and you can draw a line between them, and then you can see you know, so if the 20-year is at 3.5% and the 30-year is at 4%, we can see for each year, you're getting a certain amount of basis points for each year between 20 and 30 years. And so that would be the G spread as we go along and the interpolated spread. And then we'll look at the interest rate on these bonds compared to that spread for treasuries, because that's going to tell you the most about where people are thinking about that specific maturity as opposed to the generic trading. So that's where Paul was talking about. It's 146 to the 20-year, but the 20-year was lower. This bond had an average life of about 28 years or maturity, so that spread really should have been, so when you interpolated it between the 20 and the 30, you saw that the spread was actually 160 over the interpolated curve, which is a lot worse than 146 over the 20-year. Does that make sense? We got it? We'll have a precept and we'll have seminars later, and there'll be no quizzes, but
Mine is some underwriters will want to price off of the G spread, and some will want to price off of the T spread, and whoever is judging the success of the pricing needs to understand the difference between the two.
And so where we looked at the spreads that over the past 7 years, they've actually compressed. This is what, if you take a look at the spreads in 2015, the blue line was the triple Bs were like 200. Everything has been tighter as you get closer to here. But you still notice that triple A's have stayed in the bottom line, have stayed pretty constant and pretty strong. Whereas the weaker credits have gotten tighter, the high quality credits haven't improved as much. So obviously a weaker credit is getting a little bit of a free ride with the lower interest rates, getting tighter spreads versus the rates that they're paying. But when you look at the spread on tariff bonds, it has gone in the opposite direction. And this is where, rather than narrowing, getting tighter for the AAA utility bonds, they've actually gotten wider. And this is from JP Morgan's research data, as they've shown AAA recovery bonds versus 10-year industrials AA. And if you just look at that flaunting of it, this is in their reports, in their talk, you can see that just in the past 2 years, there's been this huge spike beginning in around November of 2021 that has driven up the spread of these bonds, but not of all securities. That's the issue. As Commissioner Urban was worried about in terms of general inflation, is rising rates going up in general. Spreads will vary over time, but here the spreads for utility tariff bonds have deteriorated such where you're paying 100 basis points more for a 1% more for a AAA bond versus a AA bond, which doesn't make sense. Not economic, but this is why you come in. This is now what, Paul, do you want to go with this? I'll just introduce the first top line and the bottom line. The top line is a triple B corporate index. So that's triple B spreads from the beginning of January of 2021 to January 2023. The blue line is AAA spreads. These are published by the Federal Reserve. They're just benchmark indicators. So what can you see? You see that where that dotted line, that's when Commissioner Urban, Jerome Powell started talking about inflation and becoming more aggressive in terms of raising rates. And worries about a recession came. And sure enough, the market deteriorated. but it deteriorated for the weaker credits more than the stronger credits, except when it comes to utility tariff bonds. So you can see that the blue line started out at 50 and has ended at 50. The gray line at the top started out at like 150, 125 and is now at 175. And Paul will tell you now how we calculated that red line in terms of looking at all of the utility bonds that were priced over the past 2 years and where they should be versus where they ended up. Paul?
So these two indices of the AAA and BBB are composed of corporate bonds with an average maturity or term of between 15 and 20 years. So what we did is we interpolated the rates on the rate reduction bonds, the securitizations, to the equivalent of 15 years, and then plotted them against these two charts, these two indices from the Federal Reserve of St. Louis. And the first point on that red line is when Southern Cal Edison issued their rate reduction bonds in the beginning, I believe it was February of 2021. And they issued their bonds at a rate that was just about equivalent to the AAA corporates, the Johnson & Johnson and Microsoft. And ever since then, the rates for subsequent rate reduction bonds have been increasing with a few dips here and there. The first dip that you see in the beginning of 2022, interestingly enough, is the second Southern California Edison rate reduction bond. So one thing you might ask yourself is, does Southern Cal Edison know something that the rest of us don't? Were they able to execute better than some of these other issues? And we'll see in subsequent charts some of the factors that might have resulted in either their good pricing or some of these other dips later on in this red line as it goes closer to the present.
So you see the divergence. So ratepayers in those states are paying more. And the bankers are almost flaunting it. Here's a research report that was published on Friday by Citigroup. The headline is rate reduction bonds, cheap long AAAs. Well, yeah, they're saying these are at cheap in terms of high rates. You can buy them for less than you're not paying up, accepting a lower rate. If something is cheap in the bond market, it means its interest rate is high versus relative to other securities. And the same publication showed, again, RRBs wide to corpse. And their chart shows you the same thing that we showed from the earlier chart from the JP Morgan data of this divergence here without any explanation. And they highlight the fact that the bonds were in the middle of 2022, changed from being in the corporate bond index by Bloomberg into an asset-backed securities index, which we disagree with. And we've given you a briefing memorandum on that, what the Florida Commission will talk later about. But here now shows, Paul, you can take over, we calculated the actual interest rates. Yes, go ahead.
Yeah, let me explain. Since every rate reduction bond is composed of 1, 2, 3, up to 5 or 6 different tranches, it's a little bit hard to compare one securitization to another. But what we have done is calculate a weighted average of all of the tranches into a single number by weighting the bond issue by the principal amount in each tranche and the spread from the benchmark in each tranche. So we get one overall weighted average spread for each deal. So this chart represents all the deals that have been done since I believe it goes back
2021.
to 2000, beginning of 2021. And what you can see is that the spreads have been increasing, pretty much what you saw in the previous chart, increasing almost consistently from left to right, or from the beginning of 2021 to 2022 to the present.
The reason that there's a red on the SoCal Ed deal is Sabre Partners was a financial advisor to the Southern California Edison company for that transaction, and officially hired in that transaction. And in the first transaction in 2021, we were not officially hired, but we were in communication with them about structures and pricing. To break down those costs, they mean something in terms of dollars and cents. And here is what they mean, if you can see this. What we did was, looking at each of the transactions, as Paul, he looked at the weighted average life and looking at weighted average top AAA securities, and then subtracted the interest rate and said, how much does that cost in terms of dollars, additional dollars, for that particular transaction? So the Southern California Edison transaction, at the beginning, first transaction, they only paid about 1 basis point over AAA corporates. So it didn't cost much at all, not getting right on top of that. We'd be happy with that to be plus or minus 5 basis points from top credits. But as you go down the list, and when you get to the yellow, that's when Bloomberg announced that they were possibly reclassifying the securities. You can see, for example, in the Texas ERCOT transaction, $2 billion on June 8th, weighted average life is 16 years, but their interest, their basis points over treasuries was almost 90 basis points, almost a full percentage, versus Southern California Edison, which was 1 basis point. They were almost 90 over. That translates.
Over treasury, no, Joe, over the comparables, the AAA.
Yes, over the, oh, yes, I'm sorry, not over treasuries. Over the comparables, the spread to comparable treasuries of the corporates. That equates into about $371 million of additional costs to ratepayers over the life of those bonds, which is about 17%. You can go down, if you go down to the Kansas Gas Electric 11.9, that's a small deal. That's a shorter maturity, 5.5 years. So when Commissioner Irving, we were talking about shortening the span, yes, but they still priced almost 85 basis points over. It didn't cost as much because it was not as long a period of time, but it still cost Kansas ratepayers about $17 million by not being able to price similar to corporates. And the others are, I mean, this is basic math. We just look at what's in the secondary market at the time. We measure that, and then we calculate. And we don't see anyone explaining why these spreads are so bad versus AAA corporates. One reason might be some did, as I told you, a private placement rather than a public offering. Private placement is what's known as a 144A. You don't have to go through all the registration aspects with the SEC for a full public offering. But you supposedly get some greater speed in private, but you limit your market because you're not selling to as broad a base. And so competition will be less and rates are usually higher. And those are the red ones that were 144A private placements. And then when you look at the Bloomberg classification, prior to that June announcement, which is the second, bonds that were structured like the Duke Energy Florida project finance bonds that we worked with Duke on in 2016, which were specifically structured not to be asset-backed securities and under the securities law. They were in the corporate index. It was all there. Other people followed that in 2021. Then it got knocked out, and you can also see spreads kind of look like they're widening along with that. I wouldn't say it's a one-to-one relationship, but it's one of those things that creates uncertainty and creates risk about what the securities are and how to best price them. So when we get to the pricing, some of the key issues is that there's an asymmetry of information out there. The sell side, I mean, the bankers have more information than we have. Our point is to level that playing field in any kind of a negotiation, dispel any misinformation or different information, control sort of the narrative of selling the bonds, and negotiate rather than them just simply taking orders. This clearing rate versus a negotiated underwriting, it goes to a fixed rate. It's too much to talk about right now, but it is a question of whether the underwriters think that you're going to sell the bonds no matter what. For example, if you told people, I need to sell my house by Friday, and you announced that, you would sell your house by Friday. Now, the price might not be that good, but you'll sell your house. So part of the negotiation is where you needed to have a credible no to say, your offer isn't good enough. We need something more, or we have to do more work here to meet the statutory objective, to meet the terms and conditions in the financing order, and be rigorous about it. We can stop here in terms of timing and just go to the questions. We could go into more detail of the actual differences of utility bonds and traditional utility bonds and securities issued bonds, but I think maybe this was a good time for a break and talk about any questions that you might have about the list of things we wanted to talk about in the process.
Commissioners, questions? Commissioner Caston?
Well, I think you've been kind of either trying to answer the question I'm going to ask, which is, why do you think AAA utility bonds are at higher rate than the lesser quality BBB bonds, corporate bonds, which I think that's what you've been discussing the whole time, and it's like this magical, mystical thing that we don't know, we might know, or what's your educated guess?
Our view is that these bonds are not very well understood in the marketplace, that they've been sold quickly at some like fire sale prices, and that there's been pushback by some of the underwriters in terms of doing the work to educate the market to get the value. If you can sell the bonds at that rate and nobody cares and nobody raises their hand, why not? This is America. You can do that. They're under no obligation to get you the best rate at all. So that's where I think you had hired us and to work with the utility to negotiate the best possible transaction and looking at what other people have done. For example, I would be very cautious about hiring Citigroup or JP Morgan based on the pricings that have occurred this past couple of years. What I just said will be controversial, I want you to know, and it would be in a transcript. But I will, is our position that we would say, if your sales force has sold these this way and has your accounts are conditioned in a certain way, how can you get us past that to get us something better? Or are you going to say now, oh, well, that's what they did last year. That's what Texas did. That's what Louisiana did. You have to pay that. You can't pay anything better. When we were in Texas in our first transactions, we confronted this. There was about $20 billion outstanding, and we pushed back on terms of the pricings to get a broader distribution, and it paid off. For example, when we did our transaction in October 2001, for example, the 10-year was like, I think, plus 35, and over the U.S. Treasury. And 2 weeks later, Morgan Stanley came with a deal for Consumers Energy, and their 10-year bond, AAA, was plus 66. So you can beat bad precedents. I mean, you can do better. And the previous deal was like plus 55. But it's difficult, particularly if there's a certain amount of momentum that these people get expectations. Because right now what will happen is bankers may say, well, it's not us, it's the investors who are doing it. It's not us, it's the market. It's the market doing this, it's not us. And they say, you're going to get the market rate. And the market is the market. Now, when I hear that, having been around, I say, well, if I'm going to get the market rate, and the market is the market, why am I talking to you? Can I just go out and get the market rate? Oh, no, you need us to get the market rate. Oh, and I have to pay you something to do that, right? Oh, okay, and then you're going to do, okay. Well, now, if you want to do that, well, then let's talk. And we'll negotiate. And then maybe we'll bring in somebody else, or maybe try to make it more competitive, or try to bring it to a broader market, like bringing it into the corporate bond market and the corporate index, why that's important to get more competition. People wanting to put it in an asset-backed index are basically mislabeling the securities and artificially restricting the market to that smaller segment that we showed you of asset-backed securities, as opposed to that broader, deeper market of corporate securities. So I can't explain. I wasn't involved in every one of those transactions to see what they did. The one transaction I was involved with, which was Southern California Edison in February of 2022, you saw it was lower than all the others. But RBC was the underwriter there in Barclays, and I'm sure they'll take credit for it as well. But there was a negotiation. And the utility there was pushing hard. Other utilities have different objectives. That's one of the issues here, is that the reason you need to be involved is that in the traditional model, you would have ongoing review and of cost of capital and bond issues and costs that are passed on to ratepayers. But in this model, as soon as those bonds are issued, you get no chance to change your mind. So if you don't get it right the first time, the ratepayer is stuck for the rest. So that's why we have to do all this work up front to get the best execution and to establish a program here. And not that there will be more hurricanes, hopefully there won't be the damage, but we understand the environmental, and we also understand that this financing tool might be able to be used for coal plant retirements or other extraordinary events. So try to establish a program and a financing order and an expectation in investors' mind that the highest quality bonds are going to be coming out of South Carolina. And those are the bonds that the buy and hold investor who's concerned about safety and liquidity will accept a low rate for that safety and liquidity. And we, for example, think that this hasn't been done, but in the state and local government, they usually make bonds available for their taxpayers to be able to invest in. We think that these ratepayers should be able to invest in these bonds, and there should be a chance that for South Carolina ratepayers who want safety and liquidity and income for the periods of time for maybe an IRA, or these would be suitable investments. AAA, high quality, and a way to get back.
Madam Chair,
Commissioner Justin Williams.
may I ask a question?
Yes, sir. You're recognized.
Sir, I want you to talk a little bit more about that. I've been thinking about that myself, and it's interesting that you bring it up. That is, ratepayers being able to benefit from this process if it actually goes forward. How would we do that? Or how would that be done?
Well, we'd have to have, in setting the distribution of the bonds, to have firms that would be able to sell to residents of South Carolina who have distribution. Some might put a syndicate together of broker dealers to supplement the distribution of the larger firms who would have a sort of a retail order period where individuals can put in their orders before institutions put in their orders. This has sort of been done in the municipal market. Hasn't been really done much in the corporate market because that's been dominated by institutions and people in lower rated bonds. We think this would be a perfect bond to try to do for retail and expand. But we'd have to do that in conjunction with the utility agreeing with it, and when we select underwriters or broker dealers to distribute the bonds, to make sure that we do a public offering. We can't do a private placement. You have to register with the SEC, and then give the time to educate people in the market about the bonds, and then make bonds available to them. Not just to big ticket institutions. The problem with this is generally the underwriters want to sell $20 million tickets as opposed to $1,000, $5,000 tickets. Individuals are not going to buy that big dollar amounts. So it requires more work, more effort. Sometimes you have to have compensation to the bankers a little bit for that extra work, but it could pay off in terms of, recycling the money back into the community to ratepayers and giving them a safe investment that they wouldn't normally get, rather than the big institutions, and at a fair yield. So it's something we have to explore. It's an idea we've wanted, but again, other firms, other places may want to go quick and fast. It would take more time. You have market risk. You say, well, if I'm spending 3 weeks talking to, the people in South Carolina and the other brokers and everything, interest rates could be going up dramatically. Well, you'd have to take that into consideration. And if there was a lot of volatility, maybe the time isn't well spent. You lose it in the market risk. But other times, though, by the time these bonds come to market, I think conditions should be a little more stable. And we can do a lot of things simultaneously where you can't offer the bonds, but you can still be talking to people. Once you file a registration statement, you cannot take orders until it's effective, but then you can do investor education. You can do primers. You can talk to people about indication to educate the market and build demand for the securities. So that's what we would do. We would want to work immediately with company and identify some underwriters or broker dealers within the state who want to work about this, get them educational materials that we can't make offers of securities except through documents on the SEC, filed with the SEC. There's timing restrictions and such that you have to do, but we would be able to navigate all of those things to be able to create the investor education and opportunity for South Carolina ratepayers to participate.
Madam Chair.
I'm hearing it.
Yes.
I'm almost finished now. Yield, Commissioner Thomas. So I'm hearing it can be done. It just may be harder.
Yes.
Or more time consuming.
Yes.
Oh, can I?
And when you talk to investment bankers, anything that takes up more of their time, they usually say isn't worth it. Let's
can
just
I
go.
say something?
Yes.
Joe? Hello?
Yes, Brian.
This is Brian Marr. I think both of the questions from the commissioners, the last two are really, getting to the meat of the coconut of this thing. If you look at all logic, there's no reason why the spread for South Carolina bonds, securitized bonds, why that AAA should have a spread as high as the recent issues have been. And I don't think anybody could give you a good explanation for that. So the idea here is you need a full court press on every stage of this transaction. You want the utility to agree that we're going to go for the lowest possible cost to the ratepayer. When you're interviewing advisors, you want them to do that. When you're interviewing certainly underwriters, you're going to say, okay, let's talk about that spread. Ask the same question. Why is it up there? And if they say, well, that's where the market is, then say, okay, well, fine, we'll talk to someone else. You have to put pressure on at every stage of the transaction. You have to do it when you have a bond team and you're actually looking at the transaction getting down to the nitty gritty. So, and it's amazing how if you put that pressure on every stage of the transaction, you'll find that it will get better. And that's the kind of thing that Sabre has been able to do in the past. That's the kind of thing that we did at Exxon. And I believe that you should be able to do that in South Carolina.
And not to undermine our efforts, but the 18 months, these pricings will be difficult to overcome. It's a challenge because they have $20 billion of supply. They say this is where when people are happy, there was a party going on. So you now need to say, well, that was then, this is now. This is a new issue. Those are how different. If you want to buy that issue, go ahead and buy the Pacific Gas and Electric. You won't have the same quality. You're going to have different headline risk, different types of risks over there. You can go for Louisiana, go places. We need to make South Carolina be the highest quality because of your diligence and regulatory environment, as well as the high quality utility that you have here, should command a premium. People should want to see these Duke project finance bonds from South Carolina in their portfolio because they know those will be safe and secure and won't have the same kind of headlines and risks that are associated with California utilities, for example, or Oklahoma utilities and such. So the efforts will require a team effort from all the folks at Sabre as well as with Duke, and where we go forward with interacting with Wall Street and investors. And one of those issues is taking on Bloomberg about this index issue, about what the justification is based on what had been achieved by Duke and the Florida Commission and Sabre in 2016. It stood for 6 years, and all of a sudden they changed it. So we want to engage on that as well.
So, sir, I appreciate all of that. You've offered a lot of information. I will say I'm very interested in providing opportunities for our ratepayers and all citizens, quite frankly, in South Carolina. And if there's a way to do that through this process, definitely want your help to have a laser focus into figuring out what that looks like and determining whether or not that's a good opportunity for our residents. Thank you.
We agree.
Did I hear Commissioner Thomas? Thank you.
Thank you. And just to follow up on Commissioner Justin Williams' questions, I think just trying to understand how this relates back to one of the early slides that you presented, and I think it had 3 different elements to it. It said something like the traditional marketing, regional marketing, and
the types of different firms: flow firms, regional, boutique.
Right.
Yes.
And so does the discussion that you're having with Commissioner Justin Williams, does that somehow relate and tie back to that type of structure?
Yes, because a lot of firms just go with like the biggest firms who did the biggest underwriting and just say that's the ones to go. You have to go with the other firms who haven't had much experience but might be willing to work the transaction more. You'd want to take into consideration rather than just experience being underwriting league tables. So the flow firms, they're into flow. They've done these transactions. They say, we've done all these transactions, just come to us, we'll do it. And that's true. Again, if we want to, when you say, well, we need to work on this one a little bit more because we want to get a tighter, lower cost, that's where we get a little pushback. And that's where we need to do work with building a team that may have underwriters, bankers in there that don't have a relationship with the company, that are just wanting to impress the commission as opposed to the utility, or who have other pockets of demand and investors who wanted to get in and buy these bonds who didn't have access to them with all those other transactions. So that's where the art of finance comes in. And that's where I said my concerns about Citigroup and JP Morgan and Goldman Sachs and looking at their historical pricings and saying, well, if that's how they've priced those and done, why would I expect to get anything better? Because their sales force is sort of conditioned there. I got to get somebody who will tell my story, the story of South Carolina, different and make the case for better rates, more to the AAA rates. And I found interesting that the Citigroup report, Citigroup is the leading underwriter, Commissioner, and they put out that report on Friday. They didn't explain why it's wide to corpse. They're just celebrating it. They're basically, this is great. You got this great thing, go get them. And I was like, well, if I'm the ratepayer paying that bond, why the hell is it, excuse me, my Catholicism.
Well, I mean, basically that relates to, okay, so it's paying a higher interest rate, so it's good for the investor that buys that bond, but not as good for the utility customers that are paying for it. I think is what you're saying.
Yes,
is that
absolutely,
correct?
absolutely.
And then the manner in which you work with whatever group it is, it ends up being the marketing group. I think you're talking about the big firms being the flow firms, and all they're trying to do is get them out there in as high a quantity in the millions of dollars to the big institutional investors compared to somebody else that might be willing to work and get a little South Carolina individual long-term investor that's maybe $100,000 is a big one to him.
That's right.
So you're talking about trying to deal with a lot of little investors versus the big institutional investors, and how do you balance that? How do you make that work? I think that's where you're trying to get.
Yes, that is right. And it is a balancing thing because there's going to be, depending at the time when we're ready to go, there'll be arguments pro and against. And will we be giving up? Could we be hurting ratepayers by delaying things for a week or two? Or would be the extra work actually benefit ratepayers? We have to make a judgment there. We don't know the total future. But we do know that that other corporations are going to make the judgment. They just don't go at any time and everything. They try to be, Exxon was strategic when they would want to come into the market. They didn't always say yes to whatever the underwriters said. They pushed back. And we've done that in various deals that we've worked on. We've done 13 transactions that we were heavily involved with in terms of the negotiation. So we know that it can be done, but sometimes it's a little messy.
Thank you. I appreciate that.
Yeah, but we want to, you're the client, so to the extent of setting the priorities, like doing that, and then showing you what the economics would be, and having a full airing of the pros and cons, and then making a decision to go forward.
Commissioner Caston, you recognize?
Thank you. And just a final thought, listening to this conversation, what you just closed with, I guess from our perspective, or at least mine, the bottom line is the bottom line. And the whole process or exercise is to get the best rate we can, not just for the company, but for the customer. For the customer, because not $1 here comes out of the shareholders. They put in about 0.5% in the subsidiary, but they get that back at the end. So, well, you answered the question that I was going to ask. In essence, the customer is paying this back regardless. Yes, and they're on a joint basis, meaning that if one customer doesn't pay their bill, the other customers have to pick it up, which is unusual. Correct. And very powerful. So I guess hearing all this and thinking about it, and you know, I'm assuming the folks from all the different institutions you mentioned, Citibank and all the others, are stationed somewhere up there around Manhattan. Probably don't visit as much as you do so far, and probably only know about South Carolina what they read, perhaps. I'm not real sure. But the things that have been discussed, with all due respect to everyone involved, we're interested in what is in the best interest of the customer. And I believe that will be in the best interest of the company too. So that, in essence, is what we're talking about here and the whole purpose of all this, correct?
Yes, to get the best possible transaction for the security that you're providing. You're putting a charge on their electric bill, and you're agreeing to adjust that charge to whatever level is necessary to pay off these bonds. You're promising never to interfere with the bondholder's right to collect the money. It is the strongest, safest credit that I can think of. Even the U.S. federal government has not promised to never interfere with the bondholders' rights to get paid. And this is why we have this debt crisis right now. We don't have that, but you have a state pledge here that says the state will never interfere. You're going to have a financing order that says we'll never change. We guarantee to implement this until the life of the bonds. That on a essential commodity like electricity. These bonds have never been on a watch list for a downgrading. They've never been, no bonds that we know of have been downgraded. They've survived through bankruptcies of parent companies, the type of structure. So you kind of wonder, again, why is it that these are not producing the lowest cost? We know it's possible. Southern California did at the beginning. We did it in 2016 with Duke. Something happened in the past 18 months. We have to fix that.
Well, I'm through with all my questioning. This has been very helpful to me, been very painful, because God, I've had to really pay attention a lot. But
I thought it scared you with that glossary of terms.
Well, very helpful. And I don't know how much more you have left. But
not much more. We're here for you.
I'm teetering on the moment of, I don't know how much more I can follow you, but I'm going to keep going. Thank you very much.
I think that's a hint to sit down or leave. You know, or when you've said your piece, sit down and leave. Okay.
Commissioner Thomas.
Thank you. And so I just wanted to ask, basically, if these things go according to plan, it's not going to really impact the earnings of the utility. It does not impact their weighted average cost of capital, their returns, or that kind of a thing. I think I'm not sure that's correct.
They may give up, depending upon how it was going to be financed. The weighted average cost. There's some earnings in that.
If it had been done in the traditional manner,
right,
as opposed to a securitization, then financing the traditional manner would have an impact on the utility.
They would get some additional earnings.
Right.
The securitization doesn't give them those earnings, right, but it takes the liability off of the balance sheet for credit purposes. So it's on the balance sheet for accounting, but it's off the balance sheet for credit. So they have $300 million or $400 million less debt at the parent level that they have to make. So that makes them stronger there. They gave up some earnings from shareholders, but they pick it up in terms of having a stronger credit.
Theoretically, because of the way it's done, then it doesn't count as debt to the rating agencies
for credit purposes.
Right. Okay.
But for accounting purposes, and for tax purposes, it's corporate debt. That's one of the reasons we have a problem with Bloomberg. FASB sees this as a corporate debt. The SEC, if you structure it in a certain way, says that it's not an asset-backed security and it's not an asset-backed issuer for securities law purposes. And we just think that these bonds have qualities that should command much lower rates than they have. But that all has to be worked through the system. And we knew that this, when looking at the topics, we needed to give you sort of a high level, but we would get into some unfortunate jargon and terms and little things. And I apologize for that. Having lived, I'm 40 years in investment banking, so I tend to talk, but I try to, hopefully we will speak better English going forward. We're in America now, let's speak English.
Thank you. That's all I had.
Okay.
Commissioner Justin Williams?
Sir, I may have taken this for granted, and I hope this doesn't come across as a silly question, but when you say that we're going to put this charge on the ratepayer's bill and adjust it accordingly to pay the amount, will that amount be adjusted monthly?
No, it's going to be adjusted probably semi-annually. There will be an adjustment, a true-up, an adjustment mechanism based on the forecast of revenues received and revenues and payments that need to be made. So they set the charge based on forecasted sales because it's going to be, so over that, and we know in 6 months there's principal payment and an interest payment. So we know a certain amount of money that needs to be done. So the charge is set so that it will produce just that amount of money. But forecasts will change. It may go up. It may be a hotter summer and therefore you sold more, you got more money in, or it might be cooler and then you got less money in. So then you'd make an adjustment if you think you're not going to have enough money to pay that bill. The adjustments usually are just every semi-annual to make adjustments, and they're kind of small. But they could be big depending upon if something happened, right?
How big? I know you can't give us specifics with this particular case, but in some of your other dealings, do you recall
They've ranged from like less than 0.5% of the bill to over, Paul, what would you say, like a couple of percent? The highest has been.
Yeah, the rating agencies don't like to see a charge that's greater than about 2%.
So it'll be a smaller percentage of the bill usually initially. Though again, since it's based on future consumption and changes in the service territory, if customers leave, the charge is going to go up on the remaining customers. That's the power of this true up. This adjustment mechanism says we are going to collect this money regardless of what goes on in the future, meaning if 20% of the people don't pay their bills and are delinquent, up dramatically from the 1% that usually is, we will take what that 20% owed and we will redistribute it to the 80% that are paying. And we'll do it again and again until the bonds are sold. So if it goes the other way too, if the service territory expands and you get more growth in South Carolina and in the service territory and there are more customers buying electricity, well, then the charge goes down because it's spread over more customers.
Joe?
Yes, Hyman.
I would just add one additional point here.
That's Hyman Schoenblum, former treasurer of Con Ed.
I was able to fix my my audio. I would add the following point. True, this charge is being added to the bill, but the alternative, if we didn't have securitization, would be that these storm damage costs would be amortized in rates over a period of time. And that would produce a charge on the bill as well, theoretically. And so the main point with securitization is that the charge that securitization adds to the bill it should be lower than the charge that would be added to the bill if the storm damage costs are simply amortized in rates as other costs are amortized.
And that's why some people call these rate reduction bonds, though we don't like that term because it's not precisely accurate because rates are going up. They're just not going up as much. So it's more of the, when if they were going to increase taxes 10% and they only increase them 6%, they say you cut your taxes 4%. In a sort of the Washington way. These moderate rate increases. They do not reduce rates from where they were before. They do not go up as high as they would have. So that's a different concept. But the shorthand that Wall Street has used is to call them rate reduction bonds because it sounds good. Not precisely accurate. And so we try to avoid that and go for accuracy rather than political expediency.
And so the amount on the bill or the percentage of the bill, I think the gentleman said 2%.
Sometimes, yeah, depending upon the size of the bond offering and the number of customers and whether we do it, how we do the rate design.
Understood. So that's going to be 2% of that individual customer's bill, meaning that, say that if we, the commissioners here, were in the service territory, depending on our usage, we're all going to pay a different amount for that.
Yes, that is correct.
So the more electricity you use, the higher your contribution will be.
Yes.
It's not a fixed line item charge is basically what you're saying. Is that right?
Generally not.
Okay.
It can be done that way if you want to do.
And
But generally it's a per kilowatt consumption-based charge, which is more dynamic and better from a rating.
recovers things quicker, doesn't it?
Pardon?
Has the potential to for recovery quicker than.
Well, you're going to get, yes, but your recovery is whatever the bond deal is going to be, just what. Because if you over-recover, the bonds will still outstanding. You just won't use that money, right, for that. So if you collected $10 when you only needed $8, the $2 would carry over for the next one. We'd lower the charge a little bit to collect $2 less and use the $2 that we over-collected to go over there, and then we'd go on and do it again.
And just, excuse me, Commissioner Williams, but you've indicated, or semi-annually on the true-up, would you agree, subject to check, that the South Carolina statute just says at least annually, so it might be annually, it might.
Yes, that's something that we usually we like more frequent because it's more dynamic and therefore less chances, and you tell the investor that, look, we're adjusting this every 6 months. There's no chance that we're not going to collect enough money. Annual was where they started, and you could have big fluctuations in annual. So we generally tell them do it more frequently because the more frequent, more certainty you're going to have the money, and more reason we tell the investor to accept a lower rate because their risks are lower.
Okay, thank you. Excuse me, Commissioner Williams, I didn't mean to cut you off down there.
I'm finished. Thank you.
Thank you.
So,
I saw him first. Commissioner Caston?
Along the lines of Commissioner Justin Williams, that being the case, it being based on a cost or a price per kilowatt hour or value per kilowatt hour, the more you use, obviously, the more you pay toward that securitization or that debt. And what we've heard in various public hearings is, many customers that can afford it the least have some very high bills. So I guess there's added incentive all the way around for hopefully the company and everyone to encourage efficiency, or helping these groups in particular help hold down their kilowatt per hour usage, or they'll be paying more of the debt.
Yeah, you also have the option, depending upon the service territory numbers, to exempt some customer groups. Low income, you could exempt some. I believe California did exempt some specific low income customer groups that added up maybe 5 or 10% of the total. I'm not sure. But in the rate design, it's possible you can still get a top rating in which not everybody is responsible for the charge. For example, in the first transaction ever done in 1997 in California, it was just on residential and small commercial, not on industrials. So the industrials got exempted. In subsequent transactions, some of the local governments got exempted and got carved out of the Pacific Gas and Electric charge and such. So there, you have some flexibility, but it's not huge, the flexibility, because if you exempt 50% of the service territory, then people start worrying about the size and the charge and the political unrest if it gets a larger percentage, because the more people you exempt, the higher the charge is going to be on the other people that aren't exempt.
Correct. All right, thank you very much.
Yes.
Commissioner Carolee Williams.
Thank you. I'm going to continue this line of questioning. And you just mentioned industrial customers, you just mentioned municipal customers, and we've also been talking about residential customers of various abilities. What are the customer reactions to securitization and to line items on their bills and paying? And I guess I'm particularly thinking about your answer in this discussion about, you know, the desire to keep the numbers in balance and to maybe semi-annually adjust for that. On the other hand, we've got the customer perspective that's got budgets, no matter what size they're paying. Could you talk to me some from what you've experienced from the customer perspective, or someone on the team?
Well, I think I don't know if anyone on the team or I think Becky's left. She would have the most experience in Texas. I think it varies in terms of whether people see it or not. Again, it's not that big of a. The biggest concern was when it was being used for stranded assets of deregulation, where there wasn't really a clear customer benefit from that was tangible. It seemed like the utilities wanted deregulation, but it wasn't necessarily customers. So the customers were very concerned about securitization enabling deregulation. But however, when it moved into, when PG&E went bankrupt, it was actually the judge put a regulatory asset of $3 billion on PG&E's bankruptcy asset balance sheet when they came out of bankruptcy the first time, about $3 billion, maybe it was less. Since it's a transcript, I need to be precise here. And the customer group, that was going to get the full weighted average cost of capital, and that would help them over time, where the bankruptcy judge said that they could get back to be an A-rated utility. The customer groups came in and said, we don't want to pay you why don't we securitize that? We'll give you the cash so we don't have to pay the weighted average cost of capital over the same period of time. And they went to the legislature to ask for securitization. PG&E initially opposed it, and then they agreed to do it. So, and since then, most consumer groups have been in favor of securitization as a way of lowering costs, because we're replacing the weighted average cost of capital in other investments, especially and when you have these very large expenditures like from hurricanes and weather events, to spread it out over time. So customers have generally been in favor of it. It's been small. It hasn't been seen as big. And it is under the radar screen, I think, under most places.
What type of customer groups are you speaking of in California?
The radical left, one called the Utility Reform Network, called TURN, is one in the Pacific Gas and Electric service territory, which is the most aggressive.
Maybe that's too specific a circumstance. So I'll ask you specifically, did someone like AARP get involved?
AARP has been opposed to securitization pretty much everywhere. I think they feel that it facilitates imprudent expenditure, recovery of imprudent expenditures. I think their view is. So they're not looking as much as what the cost is, but the fact is that the utility is getting recovery for something that they think the utility should absorb, such as when you close a plant, you got to, it's not used and useful, so you shouldn't get 100% recovery. Might be their position, in which there should be a haircut of 25 or 30. Now the utility, on the other hand, says, no, I want 100% recovery. So you get that dynamic. And they say, and the utility can say, well, look, it'll be cheaper to you because securitization, and it facilitates that. That's where ARP, I think, and some groups are saying, let's not, they're using this securitization to justify too much.
But
And
in
so-
our case, this
It
is
shouldn't be, yes.
entirely focused on storm events from
they
the
should-
past.
Right.
Okay.
It should not be controversial in that regard. It really then becomes getting the best rate, and so knowing. And part of what we do is shine the light on this to make sure you're getting the best rate, because most people don't know what the capital markets and what worth, and they just see a rate and they say, oh, we're like 3%. That sounds great. Now you see Johnson & Johnson or Apple was financing at 2.1%, and they're AA. Why is that? That's where we try to pick up that difference to say, level the playing field and to get the best execution. And it's been done. It can be done. So some customer groups opposed to it. Most customer groups, I think, will look at it from what is the alternative, as Hyman said, what would it go into rate base but for the securitization? So I think that's where the policy comes in. But if the but for they think should be disallowing certain costs, then they're going to oppose securitization. If the but for is, we're just going to put it in rate base at the weighted average cost of capital, they'll probably be in favor of securitization.
Thank you
Okay.
very much, and thank you to my colleagues who I learned a lot from your questions and kind of springboarded to that one. So thank you.
We know that this was the beginning of a dialogue in terms of giving time. We were sorry for the technical difficulties in the beginning, but we hope, from the glossary, the piece that we gave out about how to judge success, which focuses on the credit spread. If you read that, you also, when we start talking through it in the petition about different maturities and distribution, such, hopefully it will become clearer. And we'll try not to make this a black box, but something that will be transparent and be seen.
Commissioner Thomas?
Could I ask one more question, please?
Yes.
Commissioner Irvin?
Thank you. So when we talk about the average cost of capital, what you're really talking about is if we chose not to securitize the storm debt, the utility could come in a future rate case and claim that it be paid as part of rate base and with carrying charges, I suppose. Is that right?
Yes.
And the ratepayers will be liable to pay that entire bill.
Generally, yes. That's the regulatory compact.
Right. If it's reasonably and prudently incurred. And of course, storm, you can make a pretty strong case, I think, with storm damage costs, because nobody wants to have your services disrupted. Everyone has the expectation that the roads will be cleaned up and the power lines will be put back up and working. So the fact is, it really comes down to almost like a consumer protection alternative that has to be considered, assuming the terms are correct and fair to all parties, right?
Yeah, absolutely.
Well,
Just don't give away the story.
Appreciate you all taking the time to explain the nuances of securitization. As you can tell, we've got a lot to learn. we appreciate your expertise, and it's good to have a partner on our side that knows that, as they say, life is a negotiation, and you better sure know where the details are and the traps lie before you agree on terms. My daughter wanted to buy a new car recently, and she was going to pay the sticker price, and I suggested she might want to make a lower offer. So, you know, we appreciate what you're doing, and thank you for taking time to explain this to us on kind of a high level so that we can get more involved going forward.
Thank you, Commissioner. We see this first assignment as helping you establish a program and try to think, not just doing this one transaction, but trying to think about if there will be others, how you can do it more efficiently, how the financing order might be able to be streamlined. When we first did the Texas transactions, we established a series of protocols in the first financing order that had stayed there pretty much for 20 years and and that's what we want to do here, so that you could have, by the time, even though there will be turnover in staff and turnover in commissioners, that there will be some sort a knowledge base and a procedural protocol base that future commissions and staff can draw upon, and ORS can draw upon, in order to do these in an efficient and effective way. So we're looking at establishing your program, not just doing this one transaction.
You know, and that's so important, because if you get it wrong the first time, you're stuck with a precedent, and it'll haunt you.
Yes.
And we don't want that. We want to do it the very best job that we can, and be very cautious in our approach, and make sure that we're being prudent in our decisions. So I couldn't agree with you more. Thank you.
Joe, can I add one thing? This is Brian. This point is really the key to it, I think, how you get started. And what you're going to hear, if you're involved with the underwriters, you're going to hear them say, well, wait a minute, you better not push the investor too hard, because they may not buy your debt the next time. And I can't tell you how many times I had that speech from underwriters, just like the car salesman you're talking about. And the answer is, no, we'll just get the best rate we can now, and that'll be the precedent. And guess what? I bet they're coming back next time, and they do.
Yeah. Well, you got to be willing to walk away. You know, if it's not fair,
you have to have a credible no, we say.
Walk away. And there'll be others, you know, that will be happy to show you what they have available for sale offerings. And so I really like your approach. I think obviously you saved a lot of ratepayers a lot of money over your work life history. So I think we got the right team involved. So thank you again.
Commissioner Thomas, you've been very patiently waiting.
Thank you. Well, I just had one other question or thought, and you were talking about the line item on the bill and it being a per kilowatt hour charge. And have you been involved in a situation of evaluating how that compares with just a fixed charge as opposed to a per kilowatt hour charge? Has that been considered, the pluses and minuses of, or I don't even know if that's an option under South Carolina law, but
I don't know. Paul, was Indiana a fixed charge, or?
I don't believe so.
Okay. No, I don't think we've done. I don't think we have, though. There's been discussion of it. I don't know. I don't think we've been involved in a fixed charge as opposed to a kilowatt hour charge. Because again, the kilowatt hour charge is more dynamic and flexible than a fixed charge of how you're getting it, raising it. You're going to be able to be more predictable on the collection curve from a kilowatt hour charge than a fixed charge, depending upon what the rate design is.
Yeah, so it would definitely come back to
be a little more complex. You could do it, but again, you want to look at what the benefit cost is of it.
Right. And I was just thinking in terms of getting back to the low-income customers, that their usage goes way up relative to, well, the size house they're in. A lot of times their usage is out of proportion to what you would expect. But for that kind of a customer, a fixed charge might be a little bit more reasonable. I don't know. I'm just thinking about it.
Yeah, we'd have to look at it would all depend on the number of customers affected, what percentage of total collections those were, how that would affect over time. We'd have to do some analysis in terms of that. So it would be more quantitative. Paul would be doing that as opposed to me.
All right. It was just a thought.
No, I mean, there's, no, but that's what you look at in terms of looking at alternative structures and to achieve your goals. So one of them is going to be the policy issue about the generation. Which generation should pay this? Do you want to do it very short, or can you? Again, we think 20 years is about right for storm damage, kind of in terms of where the yields are. But some people have done it very short. Some people went further. Impact of different customer groups, that would be another policy concern. So should we exempt them? Should we change them, do something else? How would that affect with the rating agency criteria, and how would we explain it? So all those things I think would come up in the process based on your direction about what your priorities are, what you want to achieve. We would then go back as technicians and see how we could do that and see if it would cost anything more. Is it just mechanics behind that won't affect the marketing of the securities? Or is it something that will, well, this is going to be a complication. We'll have to explain it some more, but it can be explained and it won't affect the pricing. Or is it something, this is so unusual, it could cost us some this, and then we have to make that judgment. So this is where expertise and judgment comes in. I'm sure Duke will have their ideas, and we'll work it out.
All right. Thank you. Appreciate it.
Mr. Fichera, is there anything else that you want to address this afternoon? I think you've done an excellent job, and we certainly appreciate
our
the
contract.
information for you and your team. Anything further before we close?
No, I think that's it in terms of if we've answered your question, give you a broad overview. We'll need to get more specifics, but we approached this from saying we thought that if you didn't know anything about the capital markets, what should you know? Some of the terms, some of the broad, big picture things, and then we'll get to that inverted pyramid, from going from the general down to the specifics to this specific deal, and you'll see.
Okay, just a moment. Mr. Huber, is there anything that we need to address from your, as the neutral?
I just have one housekeeping matter. This is related to the request I made earlier. To extent ORS needs to communicate with Mr. Fichera and Saber as part of the certification process, is there anybody else on the commission staff that should be copied on those communications? Should we copy Ms. Moser on those communications as well? We're planning to copy the parties.
Yes, if you would.
Okay. Thank you, Madam Chair.
Thank you.
I think the last thing we mentioned the Bloomberg Index issue. There's a letter that we sent to you, a copy of the Bloomberg, the Florida Public Service Commission's letter to Bloomberg. We also today gave you a more detailed background memo with links and stuff. I think Duke submitted comments that they want the corporate designation. I think we're all on the same page on that. The Bloomberg has hired an outside firm to do a review of the process. We don't know how that's going to come out. The SEC just fined Bloomberg Index people $5 million for a violation. I think that's unusual. Mike Bloomberg would not like that, and I think he probably, hopefully, if this gets to his attention with this outside review, I don't think he'll like this, what they did in terms of this index, because we don't think it meets the definitions of integrity in terms of overturning what the SEC made a determination of. So we would like you to read that and see whether you can come in with us, with the commission in Florida, in terms of showing that there is more public sector, public interest concern about how these things will affect ratepayers as well as investors. Because this does affect that issue. It's one of those things on the horizon. You know, not right today, you're not going to have it, but when we get to market, if we're not in that, if we're index eligible and if people understand that, we'll have better results than if we're not.
We'll certainly be looking at that.
Yes,
This commission is very limited and prescribed on what we can and can't do. So that might be something that some of the other parties may be able to address too as well from the state. Anyway.
Okay.
Mr. Fichera, thank you, and thank your team. We certainly appreciate all the information. With that, we will close this allowable ex parte and wish everybody a good afternoon. We're
Thank you
adjourned.
very much.
Thank you.